Imagine this, you rent a life jacket, you wear it only when you're on the boat. When the trip ends, you return it. No refund, no souvenir, just safety when it mattered. That's the idea behind what we are talking about today. Hello everyone, I hope you are well. I'm Zaliang, and on this channel, I help Singaporeans make informed decisions on money, insurance, and retirement. And in today's video, let's break down term insurance. Think of it like this. In Singapore, most of us only insure things when we must. Our homes, our cars. But when it comes to our income and our family, things suddenly feel complicated. Term insurance exists exactly for that phase of life. If life insurance has always felt confusing or overwhelming, that's okay. Let's slow this down together. Think of term insurance like ordering pizza delivery. You pay for the pizza and you get to eat the pizza. That's the transaction. You don't expect a refund next month just because you didn't fall sick today. Term insurance works the same way. You pay a relatively small premium. In return, the insurer will give you a large safety net. But that's only for a fixed period of time. This fixed period is also what we call the term. It could be for the next 20 years, 30 years, or even till your retirement at 65. And if something serious happens during this period, the insurer pays out. If nothing happens at the end of the period, the policy simply ends. No payout, no savings, no cash value. And that's by design. Let's walk through how term life insurance works step by step. Step 1 is to identify the risk that you are insuring against. Start with the risk, not the product. In Singapore, common examples include setting aside funds to repay mortgage in the event that you pass away prematurely, or to replace income if a major illness or disability stops you from working. If there's no clear risk, then life insurance is usually not the solution. Step 2 is to calculate how much coverage you need. This is called the sum assured or the payout amount. It is usually based on your outstanding loans, dependents' living expenses, or income replacement for a fixed number of years. In practice, this amount often works out to be like $250,000 or more, depending on your responsibilities. Step 3 is to decide how long you need the insurance coverage. This is called the policy term. Term insurance is meant to cover you for a fixed period of time and not your whole life. Common examples include 20 or 30 years, or till your intended retirement age such as 65. Once your risk reduces, the need for coverage often reduces as well. Step 4 is to pay the premiums. You pay the premiums typically on a monthly or yearly basis, although yearly premiums are usually cheaper. And for many term plans, the premium rates are usually fixed during the whole policy term. Step 5, two possible outcomes. If an insured event occurs during the term, the insurer will pay out the sum assured. If nothing happened and the term ends, the policy simply ends. No payout, no cash value, and that is by design. Most term plans cover death by default. Many of such plans allow add-ons, what we call riders. Common examples include total and permanent disability, critical illness, as well as early-stage critical illness cover. Think of riders like toppings. The more you add, the more coverage you enjoy, but the more it costs as well. Alright, this is very important. A term insurance policy has zero cash value. You cannot withdraw money and you cannot surrender it for cash. There is no maturity payout as well. This is because this is not a savings plan. It's purely a safety net. Let's look at a simple example together. Many working Singaporeans are automatically covered under the Dependents Protection Scheme, or DPS in short. DPS is a basic term insurance policy. It covers you up to $70,000 in the event of premature death, terminal illness, and total permanent disability. The idea is simple. If something serious happened during your working years, your family receives a lump sum payout to help them meet their immediate living costs. And because the coverage is affordable, you can focus your cash flow on other priorities like buying a home, raising children, or to build up your retirement savings, all while having this safety net in place. That's what a term insurance is meant to do. Protect you first while you build the rest. So why do people buy term insurance? Term insurance is often used when the insurance need is clear, specific, and temporary. It may suit you if you have someone who depends on your income, you have outstanding loans like mortgage, or you want high protection at a low cost. The structure of a term insurance is simple and transparent, and the coverage focuses on the period when the financial risk is the greatest. Think of it like buying a strong umbrella. It is not for forever, but for when the storm risk is the greatest. Now, let's talk about the limitations. Term insurance is not designed to do everything. When a policy ends without a claim, there is no payout and there's no money back. And this is normal. It is not a flaw, but a trade-off. A term insurance may not suit you if you want lifelong coverage, you prefer to have insurance with a savings component, or if you have sufficient assets to self-insure. When I think about financial planning, I don't see it as like chasing returns. I see it as managing consequences. Term insurance exists to protect the years when the financial shock will hurt the most, when income is critical, responsibilities are high, and when your assets are still being built. It is not meant to be permanent. It is meant to be precise. And when the risk reduces, the role of your term insurance naturally changes. And that's how good financial planning should work. Not emotional, not complicated, but logical and intentional. If you want a detailed article about term insurance and how it works, I've written a full article about it. The link can be found in the video description below. If you have found this video to be helpful, give it a like, subscribe, and to share it with your friends and family members who are reviewing their insurance decisions. Thanks for watching, and I will see you in the next one. Bye.